If you invest in something that pays you 25%, the only way it's going to remain stable and sustainable is if they can generate 25% per year in total return year after year after year, pretty much becoming the next Warren Buffett. So if you believe that this fund is like as good as Warren Buffett, good for you. Mathematically, that's not true. I mean, unless we're breaking through something that never happened in the past 100 years of history. Right now, everyone is a genius. It's been like 3 years of double-digit returns. Super easy to make money. My dogs could make money on the stock market. So we have to take that with humility. Back then, I did not know about that. I felt so bad, not just losing money, but the shame that comes with it. That crisis in our couple made me realize that the most important thing in my life was not my career, was not the money that I was making, but really my 2 young children back then and my wife. I'm obsessed with being efficient. What if I pay myself $400 an hour? Like a ridiculous amount per hour. Even wasting 15 minutes is wasting $100. If you spend time and spend money with your children and your wife and the people that you love today, it's worth a lot more than dying with $2 million in your bank account when you're 85. My portfolio yield is like 2%. So I'm the dividend growth guy, but that doesn't sound really good, so we just kept the dividend guy. Don't borrow something you cannot pay back if that investment goes to zero. I just have clear investment rules. I follow them all the time, and I don't negotiate with those.
Well, hello everyone and welcome to Momentum Finance channel. My name is Mo, and today I'm super honored and excited to be welcoming Mr. Dividend Guy, Mike Heroux. Welcome to the show, Mike.
Mo, it's a pleasure. We've been talking for like already 10 minutes before you hit the record button, and I'm like just all fired up. So I think it's going to be a good discussion.
Yeah, 100%. I'm looking forward to that. And Mike, you're no stranger to the world of investing, finances, dividend investing, retirement planning, and all of that. Yet, for those who may still not know you as well, why don't we get started with the most fundamental question? Introduce yourself a little bit to our audience.
Yeah, so what I do is I help people invest with more conviction so they can enjoy their retirement. Like that has been my motto for ages. I started my career in 2003 in the financial industry. So I did bachelor degree, started to work at National Bank at that. And I got really excited about having my business on the sideline as well. So as soon as I started working at the bank, I also started blogging. So I think the Financial Blogger was my first blog, was all about personal finance. And back then what I realized is, and it is still true today, unfortunately, most people have not much knowledge about about personal finance, about credit, about investment and all that stuff. And it's not their fault. I mean, we don't have that in school. We've been hearing that we should have this in school forever, but it's not happening. So anyway, so back then I thought, well, now there's that new things called a blog. So I could start writing about personal finance. And at the same time, I realized some other people in the web space started to make money online and talking about it. And in the financial space, that was like not something. I was like telling like guys like $1 Million Journey back then or Canadian Capitalist. And I'm like, yeah, I'm going to make money with my blog. And they're just like, dude, if you make $100 a month, that's going to be like the ceiling, that you're going to be an OG. And I'm like, okay, well, I think I can do better than this. So while I was advancing my career at National Bank, I started to blog more and I had a partner. And then we realized back then we could actually buy and sell blogs like real estate. But the good thing is, back then, you could buy a blog for like 18 times the monthly revenue. So 1.5 to 2 years worth of revenue. And with the network we had, with the ad network that we were pulling in there, we were able to get our money back within 6 months. So that was kind of pretty good business of like, yeah, I'm going to buy a blog for $10,000, but within 6 months, I'm going to get that $10,000 in advertisement. And then I'm going to grow the website and so on. So we started like this, having that side gig. That was like a lot of fun. And eventually it turned out into a real business in the sense that for many years we relied on advertisement. And then Google made one of those classic updates on search engine. We lost 80% of our traffic overnight. We got killed. And then I realized never rely on something that is out of your control. And that is actually a pretty good investment advice as well. If you invest in a business that has one of its major flaws, something that is completely out of its control, it could go very well, but it could crash and burn. And it's not management's fault. It's not no one's fault. It just happens. So we restructure and that back then was still a side gig, into a membership website that became Dividend Stocks Rock in 2013, and eventually decided to work full-time on it since 2017. So since it was 2017, I'm not working at the bank anymore. I've done my fair share there. It was a lot of fun. But now I realize that instead of helping a few hundred clients as a private banker, I can help thousands of investors. And this has been my journey so far.
2017, I know it's a huge year because I think a year before that, if I'm not mistaken, you did make a decision for your family. You did a sabbatical to Costa Rica. And then what changed? What was the transformation?
It's kind of funny because that was a huge decision back then. It happened in 2015. The decision was made in 2015 and we left in 2016. So what happened back then is I'm already a private banker. I'm rolling. Everything's rolling fine on my side. We have 3 children and I love my job. I'm good at it. Like golden handcuffs, literally. You have the pension and everything. Everything rolls, but I'm happy. It's all good. But then my wife has a daycare at home. And she's kind of fed up of that. I mean, you start at 7 a.m., you finish at 7 p.m., and then it goes roll around. And then one day we are having a glass of wine on our terrace. And then she says, well, I read a blog today and it's about a family of 5 like us. And I'm like, oh, that's interesting. And they're going on that trip, and they're going all the way down to Mexico. And I'm like, wow. And they're doing cycling. And I'm like, no, wait, okay, stop. That's not going to happen for us. And back then our children were 4, 9, and 11. So I'm like, I cannot envision myself on my bike cycling my way down to Mexico. I mean, you cycled the whole day and you're not even out of you're just out of your city, basically. So it's kind of crazy. Anyway, so I'm like, okay, so I'm open to a big trip, but that's not a possibility. So we started to think about what are the other options. So we envisioned backpacking and traveling with airplane, but we ended up buying a small RV, a Class C, with the bunk beds and stuff, because we thought, well, wherever we're going to be home. At night, it's going to be better for the kids. They will have their little room per se, and it's going to feel like home. So we decided this. Of course, did not have enough money to do that, did not speak Spanish, because the goal was to drive all the way down to Costa Rica, as you mentioned. I have no knowledge in mechanics whatsoever. I'm the type of guy that sees a light in the dashboard, just go to the dealership, and I don't want to even hear about the problem. I just want to fix, and then you move on. So a lot of things that I was not ready. I still had a mortgage. We were a young family, all that. But then what we decided to do for a year and a half is to prepare for that trip. So that day didn't come up like magic money or anything. After I already had my side gig, DSR existed back then already, but it was only 100 members or something. But what I decided to do back then was to work between 8 p.m. to 10 or 11 every night. So to add more hours to my website, to my online business, to have at least a base income over there. And we eventually rented the house and then bought the RV, did a few small runs to see how it goes, because then you learn that when you turn and your stuff is not well attached, it goes all over the place. So those are the type of things that you learn along the way. And then we eventually left in 2016. And that was the most amazing year of my life. I turned 35 during that trip. And when I came back, I told my wife, you know what? I can die right now. Of course, I still want to live, but I have the feeling that I've maximized the time that I've been given so far. And this is where I realized that it's important to live today and not later down the road. And that trip is the perfect example, because we got to spend 24 hours, 7 days per week, all the time with the most important person in our lives. And that even today is not even possible. My kids are 13, 18, and 20. They would not fit in a small RV already, and one would not survive the trip. That is for sure. So those are the things you have to do. You do it or you don't. But that was pretty much the idea. Before I left, I asked for a sabbatical. So the point was to come back, just secure everything, rent the house for a year, get the job on pause, and then come back, and everything would be life as usual, right? Just a little bit poorer, but richer of experience. And then throughout the trip, I kind of realized I was, time stop. When you travel for a full year, you don't have like a place to be tomorrow. You don't have things to do. At one point, you're just like, oh, I enjoy like this beach in Nicaragua, so I'm just going to sit there for 10 days. And maybe it's going to turn out to be 12 days. I don't care. I don't know. You just let times fly. And then I spent a lot of time asking myself, sitting on the beach, watching waves for hours, what do I want to do in life? Like, what's my purpose here? Like deeper question to really take the time of like, what would make myself proud on my deathbed? And back then, my job as a private banker was to take care of all the personal stuff of business owners. So people that has like more than $5 million of on their business. And then I was taking care of like the credit, the investment, the financial planning, estate planning, everything from A to Z, literally. And every time I got out of their office, I thought, I'm sitting on the wrong side of that office. I should be there. I want to have my business, but I'm afraid. I cannot quit a 6-figure paying job. Super, like I'm good at, I love it, like I said, and everything. But then I realized that when you go into like countries with the highest murder per capita, such as Honduras and El Salvador. And we were not going to Roatan in like a 5-star hotel. We were literally entering the country by foot with the car and so on. So your perception of fear completely changes. Like I had fear of like dying from time to time. And it was kind of crazy. There was one day where we went to Lake Atitlan in Guatemala. And it says if you go on Google Earth and you look at the right to go to San Marcos de la Laguna, there are 22 airpins and the road is like this. And there's like airpins all the time. And I'm on the brakes and now the brakes are like fuming. There's like literally smokes going out of the road. And I cannot put the car on the sideway because it's either the cliff or the mountain. There's nothing. There's not even like a fence or anything. It's just that you die or you get there. And I was convinced at that time, like, okay, that's not gonna make it. Like the RV is way too heavy and it's not gonna work. So those kind of moment after that, when you come back, you're just like, dude, if I lose everything, what doesn't care, you know? I'm gonna end up in a small apartment with my family. I already worked my way up there to a good paying job. I'm gonna do it again. So who cares? But one thing I know is when I wake up and I will be 50 or 60 or 70, I will deeply regret not making that decision and not trying to have my business. So I had a chat with my wife and we decided that it was, because of course it came with a ton load of things that we could not do anymore, like no more restaurant. Long story short, when we came back, I was making about $5,000 per month with my business, but I needed $1,000 per month to run my lifestyle, pay employees and everything because it's easy to live like with $1,000 a month in Central America. It's a different thing when you have 3 kids going at school and a mortgage to pay.
Yeah.
So, and then my in-laws were just like, but can you afford doing that? And then I'm like, no, like even at the end of the month, I don't even have enough money to pay for the mortgage, but it's okay. You know, like fear again, the perception of like, I'm going to figure it out. I had enough RSP. I could have like melt down that RSP. That would have been not a great decision financially, but this is where I was ready to go to live that dream and see where it goes. And I mean, there's nothing better than having a gun on your head to work, right? So I was just working like a horse, and a few months later, it was getting a little bit better. It took a few years to get back to the lifestyle we had. And today, I mean, we're just having a lot of fun, and I'm glad I did it.
Difficult decision that turned out to be fantastic ultimately, of course. And
yes,
I feel like you've made a kind of informed decision, Mike. You knew what you're getting yourself into. You've kind of lived that other type of life whereby it opened your eyes to like what else is possible. And like in those conversations you're talking to business owners who are very successful. You can see that could be me. Why not? They're just so incredible. Early on in your life investment journey, you did take some, I would say, huge risks too.
Yes.
And I'm going to speak to that, right? So in 2003, apparently that's when you started deciding that you want to get a line of credit to be able to use that money and put it in the stock market. Walk us through that. What made you make that decision? What was the outcome? Would you do it again?
Yeah. So I think right now is a good time to say this is not financial advice.
Yeah.
You have to do it if it works for you, but not necessarily. This is not an advice at all. And of course, as you can already tell, I have a unlimited risk tolerance. Like I could not care less. Today I could lose $200,000 on my portfolio, and I could not care less because I know how it works, and I have that confidence. And not because I'm ultra rich. I am not. I'm rich of time. I'm not rich of money. So back in 2003, my first job at National Bank, I was underwriting investment loans. So there was a partnership between National Bank and Power Corporation where they were we were doing all the credit for investment loans for Great West Life, London Life, and Investors Group. And back then, Investors Group was huge on investment loan. Like their package was really like, okay, Mo, we're gonna do like $100,000 investment loans. It's gonna cost you like $400 a month in interest. You pay interest only, and that's gonna be your retirement plan. Like that was roughly the pitch. And we were doing those loans. So I thought, well, that sounds like interesting, right? So after talking with a lot of agents at Investors Group, I thought, well, I could do that too. But of course, I would not qualify for $100,000 back then. I just started working. So I went down to the branch and said, oh, yeah, I'm getting married. So I would like to have a line of credit of $20,000. Could not tell like a regular banker that you want to borrow to invest. That's not going to work. And they granted me $20,000. And I told my girlfriend that became my wife. Unfortunately, it turned out to be a good story. I told her, yeah, I'm just going to take $3,000 out of that. And I'm going to buy share of Power Corporation because the only two companies back then, I'm like 23, the only two companies I know is National Bank and Power Corporation. I'm already buying stocks of National Bank through my employer's plan. So there you go, you know? At the end of that month, I was at like $19,000, $500 withdrawn from the line of credit, buying, selling, being active, following the market. We were like a few young guys on the floor where we were doing those underwriting loans, having a lot of fun talking about the stock market, doing a lot of research, and I was quite active. That was like literally my holding period back then was probably like 3 weeks. It was just like buying, selling, and I have to say, that turned out well, but in 2003, those were really good years to trade. Pretty much similar to right now. I mean, right now, everyone is a genius. It's been like 3 years of double-digit returns. Super easy to make money. My dogs could make money on the stock market. So we have to take that with humility. Back then, I did not know about that.
And there was a humbling realization for you, wasn't it, Mike, later down the road?
Yeah, so what happened back then is I do this like for a couple of years, and then I grow my $20,000 into 70 grand. So I feel like I'm a genius, right? I buy my first house, and I'm like, everything that I touch turns into gold. Like I cracked it up. Like, you know, those guys are stupid, but I know what I'm doing. You know, it's great when you're young, the things that you know. So after that, we have our first kid, and then we're thinking about having a second one. And then we realize, oh, we only have like 2 bedrooms on the same floor. It's not going to work. So put the house on sale, and then we're going to buy another one. In the meantime, I sell the house, and there's kind of like that wiggle period where I still have kind of like my cash down for the next house in my account. And I thought, yeah, I could continue to trade, right? Of course, instead of just buying a bigger house, I'm going to buy a bigger house, and I'm going to pay cash for a brand new BMW. That's where my mind was. Oh yeah, that was. So I go into a penny stock because, you know, a friend of, actually, it's kind of funny because it's always a classic, but so cliche. My friend, his dad, works with someone that works at that company. You know, classic story. And they're about to find like metals, gold, whatever. I can't even remember what was it. So I bought it at 50 cents. It goes up to $1. So again, feeling like a genius. I'm like, dude, I'm making so much money. And then the day of like the new reports of their digging will come out any day now. So we go out for lunch at work. And then when I came back after my lunch break, I pull out, like, the first thing I do before starting working, I pull out my brokerage account just to check the market, you know? And then I'm like, oh, that's weird. They made a split. How could they made a split? That doesn't make any sense because it was like 50% exactly down. So I'm like, that doesn't make any sense. So I start reading, and I'm like, the reports came and they're not great. And now I'm short of like $10,000 for my cash down where everything was approved as is. I don't have that money. So I had to borrow money from my parents back then, that 10 grand, to put it back and seal the deal that I was able to broker. And I felt so bad. I felt so bad, not just losing money, but the shame that comes with it. I thought I was independent. I thought I was brilliant. And now going back to, yeah, Dad, I kind of need $10,000 because I'm going to reimburse you for sure. But I mean, kind of in a slump right now. So at that time, I realized that yes, it's fun to invest and take risks. But at this point, I had no strategy. I was just going in and out, having a lot of fun. Those were great years that blinded me. And then I realized that trading penny stocks, that's really, really exciting. But I also realized that with great risks comes great rewards and also great losses. And that's usually the part that most investors, especially the young one, and I went through that, we all forget about that. And we all think that we're just smarter than our neighbors, but it's unfortunately not true.
There was a question in preparation for this interview. I have some close friends on Blossom. So Carl is one of those. He wanted me to ask you this question. How do you juggle between managing your time, like, and making sure that it's a sustainable effort? Because, obviously you want to make sure you're successful in those businesses that you pursue, but also have enough time for your family, enough time for spending time with them. I mean, all those travels, like recently you did a travel too, right?
That is a really good question. And shout out to Kyle, and I have to mention that he's also a big fan of Heroux on the podcast. So he keeps on saying Heroux Fans Club. So I need to mention that. In my 20s, I was working a lot. So I had my full-time job. I also had a second job. I was delivering bread on Saturdays. And I had my side gig, the online business that was actually making money at that time as well. Not negligible. It was paying for like my sports car and for my vacation and so on. But the point was, I was always working, like literally in my 20s. And then I became a financial planner. I did my MBA full time while keeping everything running, got a second kid, and got almost divorced because that was not working. I was never there. If the kids were sick, I was really just telling my wife, well, I'm sorry, but you have to take care of that. I have a big meeting and it cannot be postponed. And then, of course, I was not the best father and the best husband back then, and kind of realized that we went to like a crisis into our couple, but we figured out how to do this the right way. So at the age of 28, I started working 4 days a week. So the deal was, and it was after reading The 4-Hour Work Week by Tim Ferriss. And in that book, one thing that he explains is how to get time off from your regular job so you can pursue other projects. And in my case, it was to spend more time with my family, but the point was the same. So while I was doing my MBA, on the Fridays, I was not at the bank and still brought in all the numbers. And since it was paid by the bank, they were just like, they were okay with that. So once I was done, I came to my job and my boss and I said, well, all right, so I've been doing this for a year and a half now. I'm top 3 in Montreal. So from now on, you're going to pay me 37 hours, so the 5 days, but I'm going to work 4, and I'm not going to work 37 hours during those time. I'm going to work 30 hours. You're going to pay me for 37, and I'm going to bring in the numbers. And if you're not happy with that, I'm just going to leave. So they were just like, yeah, don't tell anyone that, but we're going to do it. So this is how it started. So then I had more time, and that crisis in our couple made me realize that the most important thing in my life was not my career, was not the money that I was making, but really my 2 young children back then and my wife. And ever since, I always put that as a priority. Today, it's even easier because they've grown older. I mean, during fall, everyone is out of the house, so I might as well just work. But one thing that I do, though, is my oldest son is working but still living here. And then I have my daughter that is going to Cégep, that weird thing that we have in Quebec between high school and university. But the point being is that they come in the house at different time in the day. And I always take like a pause of like 15, 20 minutes to see how their day is going. Sometimes I have the opportunity to have lunch with them. So I take that time and I feel blessed to be able to have access to my children like this. But that always made that my priority. So there are now times of working and then a lot of times where I spend time with my family and my friends to make sure that I have that balance. One thing that has helped me a lot is I'm obsessed with being efficient. Everything in my life. Whenever I feel that I'm doing something but it's not efficient, I take a pause and I start working on that. And I got that from a teacher at the MBA. He was telling us the story of a restaurant doing breakfast, having problem with their toasters. So they were burning like the toasts. So every day, employees were spending a huge amount of time scrapping those toasts to make them clean so they can serve them to the client. Instead of not serving breakfast for one morning, fixing those damn toasters and never have to work on those toasts again. And that example stuck to me for everything in my life. And one thing that I do when I work, and I was doing that even as a banker at the bank, just to prioritize my time, is I was always telling myself, what if I pay myself $400 an hour? Like a ridiculous amount per hour. Even wasting 15 minutes is wasting $100. Is it worth it? And then it reframe everything you do. So you're just like, oh, I'm going to classify those papers for an hour. Yeah, dude, would you really do that if it cost $400? No, you would not. You would focus on added value tasks, regardless of what your job is. So it's not just if you're an entrepreneur, but also if you work, your boss is going to love you for that, because at the end of the day, you're going to focus on what matters. You're going to drive profit. You're going to drive revenue. You're going to make sure that you add value to your customer and you serve them better instead of shuffle, because you could shuffle paper all day, or regardless, like the job, you can just turn around and don't do this. So always focus on the critical tasks and use the Pareto principle, the 20-80. So 20% of your work is going to generate 80% of your outcome. So focus on that 20, leave the 80%, delegate if you want. I mean, I don't even mow my lawn for that reason. And once a week, I hear like the tractors and I'm like, yeah, man, I'm actually getting paid a much higher, because I still have the same mentality. I'm like, that would have taken me an hour because I have a large land. So that's like $400 every week, where those guys, they cost me like $1,000 for the whole season. So I'm making a huge deal here just by doing that. That makes me smile. And then I keep on going. And this is how I make sure I prioritize always that time. And there's one book I just read not too long ago. I was already a big fan of Like Living Now, as you can tell, because going for a year in an RV, that cost us, like, financially speaking, that was a disaster, but that was not the point. The point was to have experiences, live moments, create memories with people you love. And I read Die with Zero from Bill Perkin. It's right there actually, not too long ago. And that was the point. If you spend time and spend money with your children and your wife and the people that you love today, it's worth a lot more than dying with $2 million in your bank account when you're 85. And actually, funny story, when I was a financial planner, I had plenty of my clients, they were inheriting like half a million, 750, $1 million. They were 62, 65, 70. I mean, what's the point? I mean, they were already retired. Oh yeah, thanks Dad, but I don't need that money anymore. So instead, like you said, every year we do a huge trip. This year we went to Peru for 3 weeks with the entire family. We even brought my oldest son's girlfriend with us. We hiked the Machu Picchu. We did sandboarding in Huacachina. We hiked the Rainbow Mountain. It was so much fun, but beyond what it cost, I would have not been able to do that in 25 years from now when I will be retiring. First, my children will be older. They will be building their family, their career. They will be too busy to take 3 weeks off whenever Dad's asked for it, for sure. And second, my knees are going to hurt a lot more doing the Inca Trail, where it's just like steps after steps after steps. It's an amazing trip. But man, you can do it at 65, but you're going to suffer. Like, we did it in our 40s. That was just a lot of fun.
What was inspiring for you to kind of switch to dividend investing or gross dividend investing? It seems like, from what I've understood from your approach, Mike, those are some of the aspects of investing that resonates most with you. Is that still the case?
It is. It's kind of funny because I go by the Dividend Guy, mostly because I bought that blog, the Dividend Guy blog, in 2010. And a lot of people, they tell me, you're not really the dividend guy, because when you're thinking dividend, you're thinking like 4, 5, 6% yield. My portfolio yield is like 2%. So I'm the dividend growth guy, but that doesn't sound really good. So we just kept the Dividend Guy. So back then, what happened as we're gonna do that segue after losing a lot of money. That was in 2007. So I put most of my cash on my house. I have debt now. But I realized one crucial thing. I do not have an investment strategy. It's been like 4 years I'm investing, but I think I'm having a strategy. I think that, but really I'm just like throwing dollars here and there, see what works, and I'm having fun, but that's not investing. So at that time, I was reading the Dividend Guy blog. He was part of like the early bloggers around investment as well. And the idea of like investing in businesses that not only pay a dividend, but pay a growing dividend. And this is where the most important part appealed a lot to me, because when a business is able to increase their dividend every year, that means that they are confident in their future, and the rest of the metrics should be strong as well. Because for the company, paying a dividend is like just paying another debt. So if management says, because it's literally cash flow that's going out of their business, that gives them absolutely nothing. Yeah, besides a good reputation, but I don't think they care much, especially management. When they look at their bonus, there's not a section of like, oh, shareholders likes you. No, they will like you if you generate profit. Besides that, they're not going to like you. Thinking about that, about a business that can afford to increase its dividend, I bought the blog back in 2010 and started to craft my investing strategy around that idea. And I came with later down the road with the Dividend Triangle, which is, the triangle is the strongest foundation of all, like compared to a square or anything else. The triangle is the strongest foundation. And I have like 3 pillars there. So I analyze the revenue growth, because when you invest in a business, you want a business that can grow their sales, either by acquisition, like producing new products, new services, innovation, whatever. So you want that business to increase their sales. Once they increase their sales, the second pillar comes into play. It's great to increase sales, but you don't want to burn cash. So you want to make profit. So I track earnings per share as well. And while earnings per share depends on accounting principles, if you look over for a trend over 5 and 10 years, you cannot really play around the numbers. Yeah, you can play for 1 or 2 years, but over 5 and 10 years, if you're making profit, it's going to show. If you're burning cash, it's going to show as well. So now I have a company with 2 strong pillars. They're able to grow their sales. They're able to grow their profit. So if they're able to do both, that means they have pricing power, they have good margin, they have a good business model. So the last segment, the last pillar is the dividend growth itself. As I said, if management is confident in their business model and they see it's going well, they will be able to afford like a 5, a 6, 7, 8% dividend growth rate every single year. So when you have the 3 metrics growing at about the same pace, you found kind of like the Klondike. You found like an amazing business. Most of the times when you look at those businesses, they're thriving. And then you look at all the other metrics. It could be cash flow, could be debt, could be anything else. They're going to be strong. Those businesses, investors will like them. And if they like them, there's a stronger demand for those. And if there's a stronger demand, that means that the price will likely go up a little bit faster than other businesses. And if the price goes higher up, well, the yield will be lower in general. And this is what usually I see. So most of my businesses, most of the stocks that I have in my portfolio will pay around 2% yield. Some a little bit lower, some a little bit higher, very rarely above 5%. You have a few exceptions like everything else, but the bulk of it is really low yield, high dividend growth. And that's the perspective I had. I had tested this for a long, it's been 15 years now that I'm sticking to the same strategy. And if there's one thing I want to tell all your listeners, if you stick to one strategy that works, that could be dividend growth investing, but that could be like ETFs investing, broad market, whatever. There are plenty of great strategies. So we don't have to debate which one is best or not. If you stick to one that made their proof, like that is proven, that makes sense, and you don't switch to one strategy to another every 3 years because you look back and say, oh, I could have done better. Well, you're going to reach amazing levels. At the age of 35, when I came back to start my business, I stopped investing. I stopped adding money. So I had about $200,000 back then. that $200,000 grew up to 500 without me having to put a dollar in 2024. And now I'm starting to save again, which is great. But just to show how just sticking to the same strategy, and I'm not exceptional or anything, but I just have clear investment rules. I follow them all the time, and I don't negotiate with those. I just stick to them. And if, like, for example, I'm going to sell in 3 occasions. I'm going to sell if there's a dividend cut. I don't even wait. You announce that there's a dividend cut. My bad. I failed as an investor. I take the loss and I move on. I don't drag this forever because I don't want to have that reminder of a failure in my brokerage account for the next 2 years, 3 years, and hoping that it's going to recover. I mean, 1 out of 20 stocks recover after a dividend cut, like really recover, not just those, oh, I bought the dip and then it goes up 20%. Yes, it's still down 80% down the road. So, I mean, you made a good trade if you were, and again, that's a different strategy, going back and forth instead of like holding for a long time. So dividend cut, you're out. The second thing is I always match my investment thesis. So the reasons why I buy a stock. So I make a list, and to make that list, I focus on 3 points. Like, what's the playbook? So make sure that I really understand the business, how it works, because too many investors have absolutely no clue how their business works in their portfolio, and that's a big risk. The second thing is the growth vectors, how the business is able to run the playbook and also grow moving forward. And the third one is, does this company has economic moats, like protection, competitive advantages that are key for their success? That's how I write my investment thesis. And then I always match it with the dividend triangle. So if I think, for example, that a company ABC, is going to be great, has plenty of growth vectors, and it's a great company because I have like that very strong narrative, then I look at the numbers and I see revenue growth of like 2% for like the past 4 years. Well, I'm wrong. My investment thesis is wrong. I thought that company had plenty of growth vectors. 2% growth, that's not growth. That's just barely surviving. So definitely there's something I did not understand. And once that happened, I'm going to sell because there's a disconnection between what I thought would happen and what's really happening. And getting close to the numbers is like, the numbers always going to tell a stronger story than whatever fairy tale you tell yourself that, oh, it's going to rebound. Yeah, it's going to rebound because of what? You know, like I cannot just like sit here and say, I'm going to run a marathon and I'm going to lose 15 pounds. Yeah, it's fun to talk about it. We can talk about it all day. But if I don't have a plan that include a meal plan, a training plan, and all that stuff, it's never going to happen. So you need to be able to bring everything back down to earth. And that is the second reason. And the third one is if a company goes way above, like becomes too important in my portfolio, I just set an exposure limit because I could be wrong and that stock could go down. So I will trim at that point. It happened with Apple, Microsoft, Alimentation Couche-Tard over the years. When they become above 10% of my portfolio, I just trim a few percent. So I let the winners run as long as I can, but I just trim to make sure that I manage that exposure to risk. And that's it. So I'm not saying, oh, they're on a run right now, so I'm going to let it go to 12 or 15. No, you hit 10, you go back to 8. That's the rule. Like, sorry, guys, that's going to happen, and that's it. But by being strict with those rules, that makes my life easy. I don't have dilemmas. I don't have doubts. I just open my brokerage account, and I'm like, okay, here are the trades I have to do based on my rules, and that works well.
You've taken emotions out of it, right? So it's based on certain criteria and rules, and you follow it diligently. And that consistency is the key. Like, what to your point, like whatever strategy, as long as it's a sound strategy that you're following, be patient with it. Don't dance in and out because like coulda, shoulda, woulda. And then also sometimes as investors, we might like, oh, but that other person is doing like, how about, so maybe and then that's probably the start of like something not good is going to happen because you're constantly shifting and you don't even know at one point, like, what am I doing? To your point, not being clear about the strategy, even though you think you have a strategy, probably you don't. Yeah,
exactly.
Mike, I got to introduce a little bit to the concept of Smith Manoeuvre several years ago, and I know one of the resources I was reading about to learn more was your blog, and thank you, like it's fantastic. Are you still in the Smith Manoeuvre portfolio, or has it been to the stage whereby you kind of stopped it?
I actually had one before I traveled. I had stopped it for a while because, and here's the thing, when you do leverage, regardless if it's the Smith Manoeuvre or any, like for those who are not familiar, the Smith Manoeuvre is whenever you pay down capital on your house, you withdraw that capital to invest it the next morning. So it counts as borrowing to invest. So your interest gets tax deductible. So that's in a nutshell. But the thing is, whenever you use leverage like this, you need like 3 rules. And I've underwrite like investment loans like over $1 million when I was at National Bank. So it was really important to follow those rules. The first one is a long-term horizon. So if you don't do that for minimum 10 years, and even 10 years, it's kind of like short-term, because you want to go through a full economic cycle and ideally more than that. So if you're leveraging for 3 years and after that you want to buy a house or whatever, that's really risky, because in 3 years from now, we could go in the middle of a bear market and you have not made enough money. So that's the first thing. The second thing is, of course, super high risk tolerance. Because if you borrow $100,000 and that $100,000 goes down to 75, you still have $100,000 in debt. You have to think about that. Super important. And the third one is you need like financial flexibility or liquidity. You need to be able to pay down that debt without the investment. So that's, again, super important. So don't borrow something you cannot pay back if that investment goes to zero. If you borrow $100,000 again, and then you're down at 40 grand, that's still $60,000 that you need to pay off. So you need that. So I had to stop for a few years, but then I started again about 3 years ago. Started with $500 a month. Now I'm at $750. The goal is to get to 1,000. But since I have my business, most of my investment went to my business for a while. Now I'm starting to do something a little bit different because I want to have that liquidity. So yeah, so I've been doing this for 3 years now. It's going well. Super happy, using exactly the same strategy. Again, no reason to change a strategy that works. ETF exactly works very well. Difference is, since I'm in Quebec, there are like rules about writing off the interest that are a bit different. So using dividend investing is like makes my life a little bit easier just for that. But long story short, you could do it with ETFs as well, and that works perfectly. Yes.
What would you categorize biggest common mistakes that beginner investors make these days?
You know, our good old friend Peter Lynch said, know what you own and why you own it. And I believe that a lot of investors failed in this. It started as of late, it started in 2021 with the meme stocks. Everybody thought they were geniuses buying GameStop and BlackBerry and EMC. And now we're going into and plenty of like other strategies and stuff. And the misconception of like financial basis, like financial metrics, to really understand what's going on. As of late, for example, we're recording this on August 22nd. It's been like a couple of weeks where the Bitcoin is not crashing or anything, but not growing, like slowly going down a little bit. And I see a lot of posts on Blossom that investors are panicking because they have like covered call ETF and leverage covered call ETFs on strategy, but they don't understand because they're going down, and chances are the distribution at one point is going to have a hard time to maintain if it continues this way. But and then their question is, do you think it's going to rebound, or like, do you think it's going to come back up? And then people say, oh yeah, it's going to back up. But there's actually no, and it's not the point of like, is it going to rebound or not? But most likely the point of, do you know what you have in your portfolio? Because if you have strategy, like if you have like a covered call on strategy, or if you have strategy in your portfolio, you have a business that its sole business model literally for years now is to borrow money to buy Bitcoins. So the way they make money is by the appreciation of the Bitcoin. So they're using leverage, they're using issuing shares to do that. But what happens when the Bitcoin doesn't go up? The company doesn't generate any cash flow. So there's a problem because they have debts to pay. So it's not a catastrophe short term, but long term, if the Bitcoin remains stagnant for a while, or if it goes down, that means that strategy has to sell Bitcoins to pay down that interest or to issue more debt. And issuing debts to pay like preferred shares and all of that stuff, not exactly the greatest idea of all for a long-term perspective. So if the Bitcoin does not go up, strategy is going to have a big problem. Well, the options that you're writing on strategy, I mean, if a stock goes from $100, for example, and it goes down to $80, what are the chances, Mo, that you would be tempted to buy a call at 85? If all the narrative is negative, you're going to be, well, I'm going to pay a very small premium on that, or I'm not going to pay it at all because I'm going to wait until it goes down to 70 and I'm going to grab it for free, right? So writing covered calls on the company that doesn't do well is also going to be very hard to generate that extra premium. But all of those things, most people stopped at, MSTE pays me, I don't know, crazy yield. I don't even remember, but I mean, they're just like, yeah, Well, if if you invest $100,000 in this and you withdraw 50 grand per year, it's not going to work, because it's at the end of the day, all of those funds needs to generate a total return of 50%. If not, something else is paying for that distribution, and it's coming from your capital. There's no other way. There's no magic recipe here. So if you invest in something that pays you 25%, the only way it's going to remain stable and sustainable is if they can generate 25% per year in total return, year after year after year, pretty much becoming the next Warren Buffett. So if you believe that this fund is like as good as Warren Buffett, good for you. You found like the golden ticket to your retirement. But I just fear that too many people will think that if they invest $200,000, they can retire withdrawing 50 grand a year, and they're going to be golden for the next 25 years. And mathematically, that's not true. I mean, unless we're breaking through something that never happened in the past 100 years of history.
It's just
Maybe.
like too good to be true type of, and I mean, what you mentioned and described, Mike, makes absolute sense. Hopefully the folks don't get burned too much, but it's also, we have to remember, like, a lot of these funds are newer and they're coming fast and furious. You gotta always think about, like,
of course,
why is suddenly there's a craze among the fund managers to suddenly introduce a lot of these new products? There's got to be something like there.
But my trick here is, if you're not able to explain to a 12-year-old like what you have in your portfolio, you don't get it. You simply don't get it. And if you don't get it, that's dangerous, period. After that, you do whatever you want. But if you're not able to explain, like I just did with strategy, it was super clear, right? So now I know. And now I'm in a position to know, do I want to buy a company that, if the Bitcoin goes well, it's going to, of course, outperform the performance of Bitcoin because it's using leverage. So that's the whole thinking here. So if I believe that Bitcoin's going to go up and I'm willing to take on those super high volatile moments, well, there you go. I just found a really good investment for me. But if you're not able to explain that and understand that, you might not want to just stop at the yield.
If you could go back to your 20-year-old self, and I know you have still some of your kids are around that same age, what piece of advice would you be giving them? Maybe even let's think about that as a father, as a parent, if they're just starting with investing.
The most powerful thing you can do is pay yourself first. I mean, it's super cliche, but I mean, my kids started investing. My two oldest one were like 12 and 14. And then they convinced Caleb, my youngest one, at the age of 10. They just like, okay, so you have $300 from like Christmas gifts and birthdays. You're going to give that to dad. And we're going to, because I opened like TFSAs under my name for them. Yeah. And now it's great because I transferred the money for like two of my oldest sons. They are like 18 and 20. So they're managing their stuff. But the most amazing thing that they realized, because they started young, at a very young age, is at first they were making, like, they put in like $10 a month. There was nothing, right? And then eventually they started to have like a side job, and then they started to increase. Every time you increase your salary, you increase your saving. That's the way it goes, you know? And then my daughter is like working now at a restaurant part-time while she's doing her studies. Well, she's putting more money because she has like all the tips and stuff. So she's just growing, and she's buying ETFs. She's learning like how the market works right now. But the most important part is to constantly save money. I did that by maximizing my RSP contribution at a very young age, maximizing the employer's benefit, buying more National Bank shares. And this is how I ended up with having $200,000 at the age of 35. And when you get there, everything is so much easier, because then you benefit from the power of compounding interest. And you don't compound on like $5,000 anymore. You're compounding with big numbers.
Much bigger.
So when you start in your 20s, put as much money as possible and just live within your means during those first 10 years. And like, I read that somewhere and I found that fascinating. Like, $1 that you spend in your 20s is worth like $7 at retirement, roughly.
Wow.
If you consider like compounding and stuff. Yeah. So your Starbucks is literally like $70 every time you get a coffee.
Yeah. It's like, do I want to buy that now?
So that might want you to bring you down to maybe one Starbucks a week to really enjoy it. Because the point is not to enjoy life. I'm all about that. But there's to create that balance of, can I just put enough money on the side? But this is what is going to drive the most return per se. Not your investment strategy. Not because if you're like a genius or something. You could just simply invest in a broad ETF like a VFV or like XIU or a mix of both for the next 45 years. And as much as you just put money every paycheck, you're going to end up with a super solid retirement plan. Even if you have no financial knowledge whatsoever, that's like the super easiest part. I told my kids now, you're going to become millionaire. Now it's just a matter of like time, like an effort, but you have the roadmap. You already know how to do this and you're not even 20. So there you go. Just follow that. Never forget that part and you're set for life.
Along the way, there must have been the various resources that you've come across, books. You touched on some of those earlier on.
3 books that have changed my life. 4-Hour Workweek by Tim Ferriss. And that can apply to both like a job or a side gig or a business. Atomic Habits for literally everything in my life. Now it's kind of crazy. I even wear a ring to remind myself to not eat too much. But those are small tricks and it works actually. 100%. That really works because I'm a foodie. I love eating. I love having wine and I love pairing both. But I know for my health that I need to like balance this out. So Atomic Habits by James Clear. And as of late, Die with Zero by Bill Perkins. 3 of my favorite books by far. If you want to know more about my strategy, even as you come into retirement, because that's the funniest part, at Dividend Stocks Rock, most of my members are about to retire or retired already. We help more than 4,000 investors and they bought in the low yield, high dividend growth strategy. And there's a way that you can create income out of that. So, and you can learn about that for free. You can go to dividendstocksrock.com/income. And there's the Dividend Income for Life guide over there. The Dividend Income for Life guide explains how you can build your portfolio this way and how you can safely generate your own income. So become your own Warren Buffett. You see your portfolio as your holding corporation. And you just decide whenever you withdraw money. And there's a safe way to do it, even in a down market. That's all explained in the book at dividendstocksrock.com/income. I do a lot of research, but the point is more about which kind of person you trust. And in this regard, I really love when someone is able to be transparent and shows like the good sides and the bad sides. Whenever I make a mistake, I write about it publicly. I talk about it on my podcast. I mean, everybody knows that I burnt myself with Algonquin a few years ago, and I'm not ashamed to talk about it because I want to help investors. And I explain what are the mistakes I made back then and what are the lessons. Because I mean, honestly, the first 3 years of investment went between 2003 and 2006. I didn't learn nothing. I learned absolutely nothing. I was just making money and I thought I learned it all. It's when you lose money, when it hurts, that you have like the biggest lessons. And then it's a point of like, okay, what was the lesson again? So I cannot, I don't do that mistake once again. So those are the things that are really important.
100%. And what's your favorite podcast? I know you have your own sets of podcasts with Heroux too. Touch on that. And then if there one or two other podcasts, I don't know if you have time to listen to, but I'm just curious.
Man. Well, I run every morning and I listen to a ton of podcasts. My favorite investment one, acquired.com. They do deep dives into companies, but from like day one. So those episodes are like 3-4 hours. But for example, after listening to Costco's episode, this is when I decided to buy that stock because the metrics were great, but I was not able to come up with an investment thesis. I did not grasp the business model enough to convince myself to buy it. And then 4 hours later, I understood it completely. So those guys are making like a huge amount of research and time to do that. And they go for all kind of companies, which is fascinating. Like sometimes it's dividend paying stocks, sometimes it's like technology stocks, sometimes like they did one on the NFL as a business model.
Wow.
So super interesting to learn about that. Most of the podcasts that I listen to are more related to business actually than investing. Cause like once you found your strategy, there's no point of like going outside of that. I love the Nathan Barry show. He interviews like a lot of like great creators. So if you're more interested on the business side, how to grow your business, tricks and stuff, is amazing. And if you want to know more about dividend investing, well, I have the Moose on the Loose, which is 10 minutes podcast every day, every work day. So very easy if you just commute or something. So that's my small one. Unedited, I'm just having fun. Yeah, sometimes you're gonna hear the dogs. Actually, like one of my dogs' name is Moose, so he's really the moose on the loose. And we have the longer format, the Dividend Guy blog, that with Heroux, who's my co-host. So sometimes I'm not even there; she's interviewing other people. So we're a lot of fun. We're having a lot of fun with that.
Those are great resources. Like definitely some that I need to check out. Recently, I've started listening to How I Built This by Guy Raz. I don't know if you've checked that out. It's fascinating too. It reminds me a little bit of that Acquire thing. So he's the Guy Raz. So he interviews successful entrepreneurs. I find that sometimes listening to people that have made it, are successful, have a story to tell, you can learn a lot from even how they think, how they approach life. Like you touched on the importance of, for you, like optimizing things and how you see things. Like even the notion of, hey, when you're younger, like let's say if you're going to spend something, be mindful of the power of that dollar invested. You're not trying to say, of course, don't live your life, but be mindful of that. And that's why I go with the thought process of pay yourself first, because you're valuing your future. So you want to make sure every dollar that you earn, you set aside a certain portion of it, whatever is reasonable for you, to be able to invest and save for your future. Yeah, it's been incredible talking to you, Mike. It's been an honor for me, of course, to have you. I have so much appreciation for the work that you do, the effort that you put to educate Canadians and many, many investors from around the world. So thank you for accepting my invite and joining this conversation. I really appreciate it.
Mo, we could have done like 5 hours like this. It was just so much fun. So thank you so much for having me today. And whenever you need me to come back, I'm in.
It's my pleasure, Mike. Thank you so much. I appreciate that. Thank you so much, my friend.
Take care.